Hey guys, how's it going? Lee here. Now with the interest rates at an all-time low and savings account, not providing much either, many investors are looking at other ways in making money. In particular, there's been a lot of flow towards dividend investing, and you can see this reflected in the popularity of these kind of videos on YouTube. Now before I go into why people, including myself, invest into dividend stocks, I want to give a quick shout out, and this video is sponsored, but not really sponsored, by my new Instagram page. I'll leave a link below to that, but essentially on the page on a Monday, I post motivational kind of stuff, and on a Wednesday, you'll get a quote about business, just to kind of keep you in the loop, keep you fresh for the week, and keep things into perspective. Just a bit of fun as well. I might post some more personal stuff with stories and whatnot on there. So check it out, guys. Link in the description. Yeah, let's get back into it. So I think one of the first main reasons why people invest in dividend paying stocks is that, we all kind of want a guaranteed return on our investment, right? And being paid out a dividend is one form of that. Now, of course, obviously nothing is guaranteed. You can have a dividend stop paying you, but the closer we can get to it, the more people feel assured and secure in the place in which they're putting their money, much like it's receiving rent. And although, yes, I'm sure many of you will come out of the woodworks and say that growth investing is gonna beat dividend investing in the long run no matter what, I totally agree with you. But the types of people that invest into dividends paying stocks are also the ones that like a bit of consistency on their investment. Now, the good thing for Australian investors is that dividends actually make up about 40 to 50% of the returns in the Australian stock market, which is why we have such crazy high yields with many of our stocks in comparison to those around the world. And the dividends, most of these companies generally are paid on a biannual basis, so you get them paid 2 times a year straight into your bank account. What you do with it is totally up to you. Now, if you're an international investor looking at Australian stocks, you might be wondering, why are our yields so high? Whereas in America, their yields are rather low. Well, in Australia, most of our stocks aren't going to get that kind of growth they do in America, just because we don't have the population count and the growth in population to support that, right? You look at the top Australian companies, they're all banking and finance companies. And so to, push their services and product, they need people to loan money out to loan credit out to push, their products and services out to. But if the population isn't increasing, the people that they're reaching out to have already got those products or services. So who else are you really going to sell to? And so as a result, with the inability to reinvest into yourself and to sell more of your services and products, what Australian companies do is just pay out their shareholders in dividends. And because it's happened in such a long period, that's just what's accepted in Australia now. But in saying that though, Australia does have a few other sectors. Yes, it's hard to believe, but there are other sectors outside of the financial sector in Australia. For example, in the tech space, we do have a pretty cool little tech space in the ASX. Basically, almost none of them in America as well will ever pay a dividend. And that's because they need all the leverage on all the revenue that's coming in and a bit of debt to produce the growth that they need, especially when they're starting out small. And what you'll see even once they've picked up is none of these companies are even profitable enough to even pay a dividend. So again, they just keep holding on to all their revenue and people invest into them based on their increased valuations because their services and products come into demand and become more effective over time. Now, if you want to look at an Australian example, there's a fair few, but the one that I talk about on the channel a lot is Afterpay. Your fintech companies, none of those guys pay a dividend. And despite all the bad talk about the buy now, pay later space, it's, done very well in terms of its increase in market over in the US and over in the UK, which has drastically pushed its valuation and made me really sad that I'd sold some of the shares. So there's a reason why these wax stocks in the ASX are looked at as your golden child stocks. And in my opinion, most of these companies, like your Afterpays, are led by really good teams. I follow Afterpay personally a fair bit, and if you've ever read any of their annual reports, it's colorful, it's vibrant, it really speaks to the culture and what the company really wants to push out there and who it's really being led by. And so these type of companies won't ever pay a dividend. Even when they become profitable, I don't imagine that they pay a dividend until they've capped out their potential market growth. And for certain platforms like your Afterpays, like your Cochlears or any of that in the Oz tech space, they have such a broad horizon to keep venturing out into different markets. And you'll notice that many of them don't even really dominate in the Australian market. Many of them are actually overseas and doing their own thing just because the Australian market is so small. Reason number 2, dividend investors invest for an income. For many of us, we're looking to replace our primary income that we already have in our business or our full-time job with a passive income that we receive either through rent or, in this case, the stock market through dividends. Now, I'm going to slowly transition into this phase of being an income investor once I get a bit more growth going over the next couple of years. But the number one issue for those who are looking to invest for an income is the amount of capital you actually need to replace your income. Now, you don't need me to do the math, and you can do it with some basic maths on your own. Think about the type of income that you want per year, like what you'd be happy with, 40, 60,000 or whatever the case may be. And then just do some maths around that, and you'll quickly start to realize that the amount of money that you actually need to retire is well into the millions into the stock market. And that's assuming that, everything flows well and the dividends don't just cut immediately like that, or there isn't a drastic drop within the dividends, or you're just going to be taking a massive pay cut in your passive income for the year. In saying that though, if you actually don't intend on retiring once you've even reached your goal, or your retirement horizon is so far away, then it doesn't really matter because you can write it out, and having the dividend income actually supplement your full-time work or business income is a really awesome way to go about it, especially with those franking credits that come on through. What I like about income investing though is that it provides a number that you can work towards, right? Like I said, if you wanted to do the maths, you can quickly figure out how much capital you actually need invested into the stock market to get $40,000, $60,000, $70,000, $100,000 in passive income. And so once you have that destination, it's then also just figuring out, okay, how do I get the capital to get to that point? Because I think sometimes when we invest, we just invest for the sake of being profitable, for the sake of being in the green, all that kind of good stuff. But having a finite goal and where you want to get to in terms of replacing your income is, one, builds security, because once you get there, you're like, yes, I've got income coming through. And number two, it just gives you purpose in doing your work and in furthering and bettering yourself in business or work. The main other reason for this investing style is that, well, I guess the whole point of having extra money, right? It buys you options, it buys you freedom, it gives you that financial independence to really do whatever you want without any other liabilities over your head. And this is great for, as we age in life, you're going to have health issues, you're going to have children you're going to have to look after, and just other liabilities that come along with just having more things on you as you progress in age. I don't really know any other better way to describe it. I guess as kids, it's just health, really, to look after yourself. And so having that extra income just provides so much more freedom to do really whatever you like. And I'm not trying to sell anything. If you don't really want to invest on, for income and you just want to see the growth happen, do you. I'm just trying to put it into perspective in terms of what you can actually do with the money, because it's important to actually see the value and contextualize the whole thing. The third reason why people invest in dividends, and particularly in Australia and in the UK and Canada, is because these countries have a different form of taxation on the dividends that you receive as opposed to just normal income or rental income that comes on through. So there are benefits in Australia when you are receiving dividends with franking credits. To briefly describe what this is, basically a company who's already paid tax on their profits, which is generally about 30% in Australia for companies, and because they pay you the amount that's paid after tax, the Australian tax office then gives you that 30% back, because otherwise you'd be taxed on two occasions for the same amount. You'd be taxed first when the business receives its profits, and then taxed again when you receive it as your own personal income. And so to avoid that, they give you then the credits that's already been taxed at the company level, and that then offsets the tax liability that you have. So depending on your tax bracket, you might only be paying 2.5 cents for every single dollar that comes on through your dividends. Alternatively, you can be in the negative, in which the ATO then has to refund you the amount of tax that they've taken away from the company. Another really cool thing also, if you do your tax returns online, is that all the franking credits and the dividends and all that kind of stuff is automatically tracked through your tax file number, so you really don't have to plug in or add anything else. It's all calculated for you once you log in, and I really like that because tax just takes up so much time and it's such a headache. So the less tax I can pay with the least amount of work possible, the better. So for people living in Australia, dividend income investing can be a great way just because of the massive, crazy tax benefits behind it. And yes, there are tax benefits when you go into real estate as well, but that's a whole nother story. And plus, you don't have the nightmares and headaches of owning real estate. And if we're doing it to transition into the retirement phase, the less headaches we have, the better the retirement period is going to be. But of course, this is all assuming that we have $1 to $2 million that's laying around to replace our income. The last reason why people invest into dividend-paying stocks, and this is not just the last, this is the one that I've just came up with. There's a few other reasons why. But anyway, is that these dividends can be reinvested and compound your investment over a period of time. Because ideally when you're investing, obviously you want to increase your wealth. So when you get paid these dividends, yes, you can just spend it, but especially if you're at a younger age, you really shouldn't be, and you should be reinvesting that so that it compounds over time. Like for example, let's say you get $100 in dividends for that biannual period, right? You could buy a couple more shares, or you could make the silly discretionary move and use the $100 in dividends that you receive to go buy some food, some fancy clothes, and all that kind of stuff and wipe it out like that. You then have not gained anything in terms of the marketplace, because remember, 40% or to 50% of the returns in the Australian stock market is through dividends. And so if we're missing out that huge chunk of return on our money, given the high yields that we have in Australia, you're really missing out on a lot of return that compounds over a 10, 20, 30 year period of time. And the trade-off there really is just discretionary, I guess, fulfillment and satisfaction in the thing that we buy in that time. And let's be real, like $100 isn't really going to get you that much in terms of enjoyment. You might be able to get, some food and whatnot, but that quickly fades away. So without this effect of compounding, we're constantly having to earn new money and to pump new money into the stock market, or expecting that the market appreciates over time. And because, like I said, there's very little growth in some of these companies who pay a large amount of dividends, don't expect that growth to be coming through. And if you really want the growth to be compounding, you really have to be reinvesting your dividends back into the same companies and the same stocks in which you got it for. Or if you find a better opportunity, then moving that over to there. And when we talk about compounding, right, you get the money and you reinvest it into the same stock. I know it might seem boring of a concept just because it's like watching paint on a wall dry. There's nothing new, like you're not going out and speculating on something, dumping your money into the hottest tech stock that's going to boom, the penny stocks that are going to go, if I invest in this at 15 cents, it's going to go to $1 something. And if that happens, then I'm going to be, 10x my money or something like that. Yes, it's not flashy like that, but neither is successful investing. And there's a reason why these blue chip companies that pay a very good dividend have stood the test of time in the ASX, because they're companies that have a good moat. They're companies that have adjusted to the times and changed their ways of providing their goods and services over time, and have stayed relevant in the market for a span of 30, 40, some of these companies over 50 years in the Australian market. Now, I know that was a bit of a rant and a tangent, but hey, investing sometimes is boring unless you're constantly refinancing or doing something different, which comes with its own stresses, by the way. And for all those reasons, guys, that's why I invest in dividend-paying stock. Yes, I do invest in growth stocks as well, just because my retirement horizon is so far away that I'll be able to deal with most of the volatility that comes within the market. So I'm not too worried about that. But investing in those growth stocks is going to help me acquire the capital to then put into the dividend-paying stocks to replace my income. And my position in dividend-paying stocks will only get larger as I get older, because really, I don't have the time to be looking at all these growth stocks. And as I get older, I don't see myself wanting to put all that stress and time into finding, the next Facebook, Uber, or anything like that as well. So that's it for me, guys. Give me a like on the video. Hope you enjoyed it. Subscribe, and I'll see you next time. Cheers.